What's going on? Jordan the Maestro in the building. Welcome back to my channel, y'all. Today we're going to talk about the top 10 things that should be in your trading plan. Now, number one of the first things that should be in your trading plan is what pair or pairs do you trade. It's very important to understand what you're trading. If you're a trader who trades just about every pair and you're just looking for a particular setup, then that should be listed in your trading plan. Also, if you're a trader that has a couple of pairs that you pretty much find success in, 2-3 pairs, maybe one pair, if that's the case, then you should have that in your trading plan as well. The point is, you want to put in your trading plan what you feel most comfortable with and what you find the most success with. Whether that be trading through a setup, a particular setup that you find in the market regardless of the market, or whether that be a particular pair or set of pairs that seem to go well with you when you're trading. Number two should be, what are my confluences? We need to make sure we understand and define our confluences. What are confluences in the first place? So confluences are, in a way, our confirmations, right? What allows us to know that this is kind of hinting towards our bias for a bullish run or a bearish run, right? So when I'm looking for a confluence, in other words, I'm kind of looking for a confirmation towards my bias on whether the trade should buy or it should sell. So for example, a couple confluences could be Fibonacci retracements, or break and retest, MACD indicators, or simple moving averages, crossovers, etc. You name it. But whatever those set of confluences are for you, that right combination of things that need to happen where you feel very confident entering the trade, that needs to be clearly lined out and written explicitly in your trading plan so you know what you're looking for before you even enter a trade. Also, number three, what's also important is knowing what is the minimum number of confluences that I need to have in order to enter a trade. Now, maybe you like about 5-6 confluences, but there may also be a minimum where you're comfortable enough that if I get these 3 or if I get these 4, I still feel confident entering a trade. So if I get price at a support, it broke out, gave me a retest, and it lines up with the Fibonacci retracement, maybe that's enough for me to enter the trade, even though I'm not getting a couple other confluences. And you have to make sure you understand how you adjust things, and you need to know what that combination actually is, okay? So just because there are 6 confluences, it may not be any 3 confluences that necessarily make you feel comfortable to enter a trade in the first place. It has to be the right 3 or the right 4 or the right 2, right? But one thing I suggest is that you size up your confluences. What do I mean? I mean, you try to measure which confluences are strongest all the way to the weakest, and maybe you just need 2 of the strongest confluences to come together for you to feel confident enough to take a trade, or 2 strong confluences and 1 not that strong of a confluence. But either way, you need to figure out what is that formula, what is that combination of things that make you the most comfortable into making sure that you are entering a trade with the most confidence possible. And a lot of this is achieved by back testing. By back testing, I'm able to see what combination of things happened in the past that let this trade go off, right? What combination of things that I'm witnessing that fall into my confluences had to happen, or what minimum combination of things happen for this trade to have a very high percentage of going on towards your bias. That's what you need to do, and that's the gritty work that you have to do when you are back testing, making sure you understand which confluences are absolutely necessary and which confluences, if they all come together, can put you in a really good situation to make a lot of money. Number 4 is, how much do I risk per trade? Now, this could be a tricky one because for some people it may change. It may be dependent on the situation. And for others, it may be a set amount for each trade, at least for that week. But you need to decide before you enter a trade, how much are you willing to risk for that trade? Where's my account size at? How much am I okay losing per trade and my emotions won't get too caught up and I won't be breaking my trading rules because my emotions are taking control? So you need to make sure you define how much you're willing to risk per trade. And if it does change from trade to trade, then you need to figure out what exactly causes that change and what it would change to depending on the situation. Next, number 5 is, how do I set my stop loss? Notice I didn't say how much is my stop loss. How do I set my stop loss? Now, we have two different types of things here. We have a set stop loss, meaning no matter what trade I'm in, I'm always going to set a 30 pip stop loss. You can have that as a trading rule, that's fine. However, personally, my opinion, I don't think that you can use that unless you are trading one or two pairs that kind of have similar volatility. Now, when you're choosing a stop loss, that should be more based on structure, right? If you are in a bullish move, your stop loss should really be below the previous low. Or if you're in a bearish move, then your stop loss should be above the previous high. Either way, you want to make sure structurally your stop loss makes sense. Sometimes 30, 40, 50 pips per stop loss typically is enough to be above or below that structure of interest. But the point is, you don't want to be just driven by the amount of pips for your stop loss. You want to be driven by what the structure tell you. And guess what? If structure tells you sometimes that maybe you might just need a 60 or 70 pip stop loss just to make sure that this lines up with structure, guess what you do? You should probably lower your lot size and go with what structure tells you, okay? There may be different opinions on that, but I do think that if you line up with structure instead of just having a set number, you're better off in the long run. And that brings us to number 6. What is your lot size? Lot size is going to matter. Lot size is also going to determine how much you're willing to risk per trade. And depending on the lot size that you use, you can put yourself in a very healthy situation or a not so healthy situation. It also depends on what type of trader you are and where you are in your trading journey. More skilled traders are able to put in higher lot sizes and risk a bit more. It's just their level of skill. However, for new traders, and to be honest, just a right rule of thumb, it's very important that you do manage your risk well and risk no more than 2 to 3%, especially if you have a decent account size. Okay, risking 2 to 3%, there's no harm in that, to be honest. And if you were to ride that out throughout the year and you have a consistent, profitable trading strategy, risking 2 to 3%, to be honest, no matter where you start from, yes, patience is required, but you can get to the very, very high numbers as long as you are diligent enough to follow your trading plan. And also, when market conditions change, be willing to adjust the amount of pips that you're going for just to make sure you continue to keep up and maintain your win rate and your success in the market regardless of the conditions. Number 8 on my list is, how many trades do I take per day? And is it affected by wins and losses? All of this, again, needs to be decided before you take a trade. Okay, you need to know how many trades you are taking per day, but it may depend for some people. For some people, they may just want to take 2 trades per day no matter what. But for others, if those 2 trades are wins, they may write in their trading plan that it's okay for them to go for a third at half the risk. That's fine, as long as it's in your trading plan. Or if it's 2 losses that I take, I stop trading no matter what and I no longer trade for that day. That could be in your trading plan as well. The point is, before you enter the market, you really need to have these well-defined and well-ingrained in your mind, because your emotions, again, are going to be at play when you're in the market. When you lose trades, you lose 2 back-to-back trades, you know that revenge trading is going to be in the back of your mind. And if you don't have that one thing in your mind, which is your trading rules, what does your trading rules say? Then you're gonna succumb to your emotions and you're gonna end up over trading, over leveraging, and more than likely really bringing down your account, if not blowing it. Okay, make sure you put that in your trading plan. How many trades I'm willing to take per day, and how is it affected by wins or losses, if so. Number 9 on the list is, what do you do with news? Some traders decide to trade news and trade the initial release, the first minute or first couple seconds, and whatever direction it goes, they'll scalp out for a quick 50 pips, I don't know, whatever. But other traders decide to trade after news. Other traders decide, you know what, I'm going to be in a trade right before news and I'll let it go off, but maybe I may be liable to slippage. But either way, by experience, you kind of figure out what's the best thing to do during news. Personally, I'd prefer not to trade during news because so many things can happen. Some news releases are clean and they are one directional. Other news releases could be very funky and they could wick down for 100 pips and wick back up for 300 pips. Pretty much there's a lot of losers in that type of situation. So you choose what's best for you when it comes to news, but you need to know that ahead of time before news comes out and how you're gonna handle that. Whether you're gonna ignore what happens to the market and close your browsers and you don't need to see what's going on so you don't succumb to that FOMO, or you allow the market to move and you wait for your opportunity to enter the market based on that news release. Either way, put that in your trading plan so you know how to handle that situation. Last but not least, number 10, what is your goal? What is your daily goal? What is your weekly goal? What is your monthly goal, right? We need to also write down our goals. It doesn't mean that we limit ourselves to just the goal, but it's also important to understand that if I know that at this number, if I make this number for the day, and I know that this number makes me satisfied, then maybe I don't have to enter another trade even though I'm allowed to in my trading plan. Maybe I could limit myself from over trading if I hit that mark for the day or for the week on a Wednesday, right? Maybe I could just stop trading because that was my goal. The more you limit yourself in the market, the less you are in the market, usually you tend to make more money. So the point is, you want to limit your exposure. You don't want to be too greedy. You want to make sure you put yourself in the best situation possible to be in the market not longer than you need to be, but when you exit with your hands full, with your bag of money in hand, okay? So I really hope that these 10 things are in your trading plan, and if they are not, you need to find a way to get them in your trading plan. Before you take any other trades, have all of the answers to all of these questions and make sure it is well ingrained in your brain before you take another trade. I hope these tips were helpful to you guys. Continue to plan your trades and continue to trade your plan. That's how you find success in the markets. I see you guys, Jordan the Maestro. Till next time.